Good day and welcome to the Alton and Bird Weekly Webinar Series, Making the Most of Tax Reform. Today's session is Section 199A, Deductions for Qualified Business Income. Today's conference is being recorded. At this time, I'd like to turn the conference over to Scott Harty. Please go ahead, sir.
Thank you very much. I appreciate that, and good morning, everyone. Thank you for joining us. Again, my name is Scott Harty. I'm a partner in the Federal and International Tax Group with Alton and Bird, and I'm joined this morning by my partner from the Charlotte office, Clay Littlefield. Thank you for being here. Just to let everyone know, our last two presentations are on our website, so if you did miss those or you're interested in them, you can access those on the website, and slides are available as well for you to access. This week we're going to be discussing the deduction for qualified business income under 199 Cap A, and then next week we're going to start a little bit of a series on foreign-related issues, and we'll begin with the BEAT, and then we'll move into GILTI and foreign tax credit issues. So our agenda for today is we're going to provide just essentially an overview of 199 Cap A, and then we're going to address specific issues that the final regulations raised or addressed. And as just a general reminder, our goal is to provide an overview of these topics and spot issues that may be of interest. And so, as always, we may not address specific issues that you're concerned with or that you're interested in or looking at. I think that's particularly true for this topic, which is incredibly complex. Involves a number. It's for me, not for you.
No. For me.
But unfortunately, we can't touch on everything or get into it in sufficient depth. But hopefully, we will address most of the high-level issues. But we do welcome questions. So if you'd like to ask a question during the presentation at any time, you can email those to us on your browser. Just in the Ask a Question box, you can type those in. And just so you know, those questions are private. Other participants cannot see it. Only the moderators can see the question. So feel free to ask those questions. If we don't answer the question, you will certainly get a response from us, but hopefully we can answer it during the call. We'll do our best to stay within 30 minutes. There's a decent chance we might go a little bit longer today, just given the magnitude of this topic. What we've done with the slides is we've tried to provide a little more information than we may cover so that you can take those away with you, and obviously you can always ask us questions afterwards if stuff arises. So
I would think two general themes for today would be that most questions that you really want answers to are inherently factual, and to the extent we haven't answered it, they're beyond the scope of the regulations.
Yeah. Well, and that is true for a lot of these issues. There is a repetitiveness to it in terms of
over and over.
A lot of it is factual determination, so we're going to touch on that quite a bit.
Again, I think we were talking before the call, but they touch on some these rules, while they're all integrated, they touch on some areas that have been continually difficult for tax policy to address, as what is a trader business, and can you have multiple ones, and what's the definition of independent contractor, and just stuff, so
right.
Having to draw those lines is part of the reason we've got all this complexity in here.
Right.
And so to the extent there's still an answer in the question, that appears to be intentional.
And why there just really aren't any bright line tests.
Yeah, that's right. They don't want to be games. That's right. Sorry, Scott.
Right. No, that's good. So let's just do a quick overview of 199 Cap A. So just in general, this is a temporary provision, so it's going to expire. It's applicable for tax years 2018, the year just passed, through 2025, and then it will expire. And essentially what 199 Cap A is it gives non-corporate taxpayers a 20% deduction for their domestic qualified business income that's earned from a partnership or an S-corp or a sole proprietorship. And if they earn that qualified business income with respect to a qualified trader business. So those are obviously two very important terms that we'll talk about. Effectively, what that means is that income that comes through this, let's say, pass-through entity is subject to a maximum effective rate of 29.6%, which is somewhat misleading because sole proprietors, independent contractors are eligible to claim the deduction, but it's kind of commonly referred to as pass-through income or a deduction against pass-through income. All right, so just...
Well, and before we go, I think the concept, and there's a concept in the regs, I don't know if we'll catch on later, but you'll see a concept called RPEs, or relevant pass-through entity, which is basically covering that partnership S corp or sole, or not sole proprietorship, but I guess, but the partnership S corp angle, saying that you can pass through these entities. But then the only reason that's really relevant is that there are going to be areas where there aren't RPEs because they're not pass-throughs, but they're still allowing a pass-through for certain types of income. So.
Yeah, and that's a good point, because that is a term used in the regs that we touch on a little bit later, but you'll see this acronym RPE, which refers to a relevant pass-through entity. Yep. So qualified business income, or QBI, essentially means domestic business income, but there's obviously a number of carve-outs, some of which we've listed here. Investment income is carved out, dividends, investment interest, cap gains. Compensation for services to a trade or business is carved out, but compensation paid by the RPE, the entity, would reduce the QBI of the business. Qualified business income does not include guaranteed payments to partners for services that they render in their capacity as a partner, and then also payments to partners for services rendered not in their partner capacity. So there are several carve-out. There's more in the regs. These are some of the more significant ones.
Well, I'd say, yeah, so then that last bullet, and we'll get it, the next slide talks about the RIC-REIT distinction a little bit, and they added in the final regs, and there's some proposed regs as well, but the qualified, at least on the qualified REIT dividends, is the holding period. So you've got a 45-day period there, and I think just one commentator, in addition to being annoyed with the administrative burden that's going to impose on trying to figure out what's qualified and what's not, they did confirm that it doesn't have to be the 45 days solely before the dividend payment. It could be any 45-day period during that time. So just in case you were wondering, they answered that question.
Good point. So let me just flip down to just one other thing with respect to partnerships and qualified business income. So there's an interesting potential issue here for partnerships where they're not required to make guaranteed payments to their partners, and so to the extent they don't, then partnerships may not, reduce their QBI. If they base compensation or are paying their partners based on share of profits, then the relevant pass-through entity would have higher QBI, presumably. So partnerships may have a little more flexibility in kind of being able to maybe not manage their QBI as compared to S corps. And then treatment of RICs, maybe you can touch on that real quick.
Yeah, I mean, again, it's just the RPE concept. They want to give they want to allow the qualified RIC dividends to pass through a RIC. So some commentators suggested that, RICs be also listed as RPEs. And again, rather than going that route, maybe for just consistency purposes, they came out and said, no, we're not, it's not a pass-through entity because, a RIC's a corp, a mutual fund, regulated investment company is a corp. But we're going to let you go ahead and treat the qualified RIC dividends that come through there as a good income for 199A purposes. They have reserved on the corresponding public trade partnership or PTP qualifying income payments of the qualified PTP dividends. And again, they're asking for comments on that. They said, these raise novel issues. Please give us comments. So that'll be yet another thing we can talk about at the future, time as to what rules are going to come out with respect to the pass-through PTP dividends.
Okay. So let's turn to just real quickly to qualified trader business. Obviously, a very important definition addressed extensively in the final regulations. So basically, a qualified trader business is any trader business other than specified service trader business or essentially the business of performing services as an employee. And the meat here, at least with respect to the final regulations, is the specified service trader business. And that is any trader business involving the performance of services in a variety of service-related fields. We've listed them out here. We'll talk about them a little more in detail later. Or any trader business where the principal asset is the reputation or skill of one or more of the employees or owners. That language, owners, was added at the end of the legislative process because it only referred to employees initially, and they added skill or reputation of the owners as well. So the final regulations touch on that as well. Also excluded in terms of a specified service business are services in investing or investment management services, trading or dealing in securities or partnership interests or commodities. That is also treated as a specified service business. Noted that engineers and architects benefited in the final legislation. They were carved out at the end. They still benefit, and they were initially included and then specifically carved out and removed. So those types of businesses are not specified services businesses. Okay. Just moving on to there's a limitation on an important limitation on the ability to claim the deduction. So generally, the deduction is equal to 20% of the QBI, the qualified business income, but there's a separate limitation. This is a very complex limitation, but essentially the deduction would be limited to the greater of half of the individual's share of the wages paid by the business, or 25% of the share of the wages paid by the business, plus 2.5% of the unadjusted basis of qualified property.
I'm going to blindfold you to repeat that to us.
It's not easy. But essentially, you have to do a two-part calculation looking primarily at the wages and the basis of the property. And the greater of those two numbers is your limitation for your 20% deduction. There are examples in the regulations and actually in the legislative history that walk through this calculation. It is fairly complex, but we're just going to note it.
But they're beyond the scope of this presentation.
They are beyond the scope of this presentation, but we will circle back to it because there will be relevance a little bit later on. Okay, and then finally, just in terms of the overview, and this is important for income thresholds, that individuals that have income below a threshold can take the 20% deduction, even if their income comes from a specified business or the W-2, the wage limitation might apply. And those I've listed those thresholds.
Yeah, we're going to have slides later in the presentation that goes into what these specified service businesses are. And we were chatting before this discussion that, generally speaking, there will be a slide we could have titled "You can stop listening now if you are under the threshold," and or you're going to be phased out, or you can and then you kick back in if you meet these criteria, then you need to be paying attention. So that's why these thresholds apply. Yeah,
and you're fully phased out at $415,000 for joint filers, basically, $207 for single, but in between there, you have a phase-in rule.
And I'm going to flag it here just in case we don't. I know it's one of the last slides here, but the independent contractor point you make, just to catch it now. It's one of the back slides, but go ahead and make the point. I think about there's always been that tension about independent contractors and employees.
Yeah,
and
right.
So while it's in the intro, there is still a concern about the benefits that independent contractors have of availing themselves of these rules and that employees don't.
Yeah,
I want to touch it now because it's kind of a bigger point.
Yeah. The last point on this slide here is important because employees can't take this deduction on their wage income, and so there's a concern that employers might potentially reclassify or misclassify employees as independent contractors, which in M&A is always a fairly significant issue. So the concern there is that an independent contractor could take the deduction for the same services that an employee couldn't. And so you might
and we'll get to it. We've got a slide later. There's a look back procedure, but generally speaking, the point is the IRS thought of that.
Yeah, exactly. And so they basically are addressing this kind of concern about widespread conversions. So okay, all right. Let's turn over to the final regs here. So final regulations under 199 Cap A were issued about 10 days ago, January 18th. Now, the final regs, since they were finalized in 2019, don't apply for tax returns filed last year, technically, but taxpayers can rely on them if they choose to. So you can rely on the final regulations for 2018, or you can rely on the proposed regulations for 2018. But if you choose one, you get everything. So it's kind of an all or nothing. You either pick the final regs or you pick the proposed regs, in which case you get that. And so there may be, trade-offs as to which package you want to choose, because there are important distinctions between the two. So anyway, whichever one you choose could have implications, so you'll need to look at that. All right.
So we're looking at this one. All right. So I think a good chunk of what these regulations address is just what is a trader business, and they define it generally for 199A purposes as hooking up with the definitions in Section 162, generally with some exceptions. But the actual trader business itself is not defined exclusively for 199A, other than restricted to that reference. The general rule in the final regs is a trader business does not include the trader business as being employees, just like the proposed regs. Now, I think we were referencing this earlier. The commentators kept saying, asking for guidance on, so, give us some lines on what is a trader business, bright line test, factor-based test, safe harbors. Going back to the theme of these regs, the answer was those are inherently factual questions and they're beyond the scope of these regulations. They cite in those regs to two Supreme Court cases, one from 41 called Higgins, which just effectively just says, it's, whether you have a trader business versus a hobby is, based on all the facts and circumstances, and but you got to have a good faith profit motive. There's also, and I was mispronouncing, the Grotzinger case in '87. It was a gambling case about whether a guy's activities rose to the level of being a trader business, and that is that we'll hear the phrase, continuous. You have the regular and continuous activities, considerable regular and continuous. Mm-hmm. So that is the regs just say we're still relying on that. We're not going to give you bright line test. We're not going to let you game us. Let's see what was all else on that slide. There's also the issue of that's whether you have a trader business is separate from whether you have multiple trader businesses, which has also been somewhat of a debate. And to give a little background on both those points, I mean, at least in an analogous case, in my experience, the trader business issue is relevant when you've got people who want to take certain deductions that wouldn't be eligible if they weren't a trader business, but if they are, I mean, they'll securities trading, activities where people want to take a position after they lost money that they were in the business rather than just doing this on their investment side. So I think part of the reason we have these regs is the IRS worry about being gamed, and not just the 199A consequences, but even though they say these are for 199A purposes only, but not really. We're all going to analogize to them. And the same thing for multiple businesses. I think people are worried about people who have other careers using these amounts or these deductions for offsetting. Yeah. So.
And so kind of whether you're in a trader business is certainly a very important consideration, and the IRS is essentially falling back on case law and not offering any clear test. But then also taxpayers were concerned about, okay, well, what if I have multiple trades or businesses? How do I delineate where an entity, an RPE, might have multiple businesses? And the IRS declined once again. So that's factual. We can't tell you whether you have 2, 3, or 4 or one business. So that you just got to look at the case law.
Well, and you addressed that third point, but I love it because it's the IRS believes. Well, while they acknowledge it's possible to have multiple trades of business, they believe that it probably should involve having you have to have separate methods of accounting, or capable of being capable of having separate methods of accounting, and also that you need to keep separate books and records.
Right. Yeah, and they do. I mentioned in this parenthetical that there's clearly reporting that if you do have multiple trader business, you got to report that, and it's reported separately, and each business is reported separately. But I think there's kind of a general reluctance to acknowledge that there are multiple trades.
Again, this is one of those situations. I think they want to see how this plays out and make sure that they're not giving all the other repercussions and other rules that might get whipsawed with.
Yeah. Okay, so let me jump down. I don't know.
We're doing the rental rules?
Yeah, let's do real quick the rental. This is important for whether you have a trader business.
I think so. I think it's trader business. I think it's a question for people who want to have rental real estate, which is a lot of people. So again, they came back and said, giving you a bright line rule, we understand that you want a bright line rule for rental real estate, but again, that is beyond the scope of these regs, and it's inherently factual. The preamble says that relevant factors, before they get to the safe harbor, they say the relevant factors might include the type of rented property, whether it's commercial or residential, the number of properties, how active you are, as or you or your agent are in doing the business, and the other ancillary services provided in the lease, whether the lease is long-term or short-term. I just thought it was interesting they said it might include. I guess it means they might not include those. It's weird. It's an odd phrase. But anyway, at least with respect to real estate, because again, we right now really like real estate, which is good. But they gave a safe harbor, and they issued it along with these regs. Notice 2019-07. I think there's a typo on the slide. It's not from 09, because that would be something we'd have used already.
Yeah.
But anyway. It's essentially saying they're going to assume you have a 162 trader business if you have at least 250 hours of services performed. Those have to be in the, they delineate between the being in the business of real estate and being in the ownership and investing of real estate. So they say those 250 hours have to be in maintenance, repairs, collection of rent, expense paying, providing tenant services, efforts to rent. They cannot include arranging financing, acquiring the property, reviewing financial statements, driving there and back to the property. Importantly, I think for making this safe harbor usable for people, the 250 hours can be performed by not only the owners but also their agents and their employees. Two things just knock you out of the safe harbor off the bat, and one of them is if you're leasing the property under a triple net lease, then you can't rely on the safe harbor. Also, if you use the property at all yourself. So I'm thinking we need to get in the side business of doing some kind of like timeshare equity swap where, I'm swapping yours, you're swapping mine, and, we'll still do the safe harbor. We can keep putting. Yeah. That's not legal. That's just a thought I was reading. I'm sure somebody else think of that. There's also a funny thing. The proposed regs had two examples involving unimproved parking lots, and those regs assumed it was a trader business of managing and leasing these parking lots. The IRS then had commentators ask for confirmation that the leasing of unimproved land was a trader business. The IRS said that was not intentional. That in fact you shouldn't assume that because they said you should assume it's a trader business. It in fact is a trader business, and so to avoid the confusion, they've removed those references. So
okay,
there you go.
All right, let's just move quickly to the, just real quick, I want to move to the aggregation rule, which is important because essentially each trader business is looked at separately for purposes of applying the limitations, so determining whether it's a specified services trader business or wage cap limitations, whatever. You look at the businesses distinctly, but the regulations permit aggregation of businesses. And so an individual or an entity, the RPE, which was added in the final reg package, may aggregate multiple businesses into a single business for purposes of applying the limitations, the wage limitation and whatnot. Although it's not required, it's possible. And it's permitted under limited circumstances, and so we've listed out what the circumstances are, but generally you have to have common ownership between the two businesses for the majority of the year. Particularly it has to be on the last day of the year, but during the majority of the year. The items must be reported on a return in the same year. None of the businesses can be a specified service trader business, and two of these following factors must apply, which is either the businesses are coordinated, or they share facilities, or they're the kind of businesses that are normally offered together. So under those circumstances, you can aggregate multiple businesses. Real quick, just an operating rule with respect to that. A couple of operating rules. An individual or an entity cannot disaggregate businesses that have been aggregated. So if you have an interest in a lower tier partnership and it is chosen to aggregate multiple businesses, then that has to be continued. Also, additional businesses, if you have an add-on later, you can always aggregate a new business as well, or you can aggregate businesses in addition to lower level businesses that have been aggregated. So there are instances where you can add on. Also, if you fail to aggregate a business that maybe you later want to aggregate, you can't go back and amend that on a return. 2018 is the only year you can do that, but otherwise, once you file, you're stuck with either the aggregation or not. And then finally, if there's a change in circumstances later, you can disaggregate businesses down the road, but that's just based on a change in circumstance. Okay, let's turn quickly to specified services. Very, very important topic in the statute and in the regulation.
Well, let's get to are you part of the favored group of people doing work, or are you part of the unfavored group of people who are,
yes,
who if we all got to break, we'd break the fisc, right?
Yeah, and in a service-based economy, there's a lot of people that are excluded.
Except for people who aren't.
Yes, if you're not. So
lawyers are excluded, which is why are included in the specified, which is why there's a little bit of annoyance.
Yeah, along with many, many others, probably some that are listening. But so basically, we're trying to separate labor-intensive businesses from capital-intensive businesses. Kind of the bottom line. And these specified services are seeking to identify labor-intensive businesses. All right. So why is this relevant? If an individual exceeds this phase-in range, if you're above the threshold and the phase-in, which is, let's just say is $415,000 for a married couple, then income from the specified service, trade, or business can't be taken into account for purposes of the deduction. So it's very important for those individuals. If you're below that threshold, or you're within the phase-in range, then you can still, there's a complicated formula, but you can still get some of this.
And every time I've read that formula, it makes my head hurt. It's very complicated.
Very complicated. Also, the final regs acknowledge that a business may have some de minimis amount of kind of service-related income, and so there's a special rule that essentially says if the business has gross receipts of $25 million or less, and 10% of those receipts are attributable to specified service, then the business will not be a specified service, trade, or business. If the business has more than $25 million in gross receipts, then the percentage is reduced. Only 5% can be income from a specified service business. So if you fall within that de minimis, then that's okay. You can have a certain de minimis amount of income from a specified service, trade, or business. Okay. So just to reiterate, we mentioned this before, but it's a little bit of a restatement. Specified service businesses are these specific fields: health, law, accounting, very broad.
Performing arts.
Performing arts, athletics, or, and then this is an important or, any trade or business where the principal asset of the trade or business is reputation or skill of one or more of the employees or owners. And so there was a question as to how broad could this reputation or skill language be interpreted, particularly when they cut engineering and architecture. Could you still have it? Could it apply? And basically, the Treasury said a broad interpretation of this rule would create substantial uncertainty and not be good for anybody.
Well, for anybody.
It would be difficult to administer.
Before we close, I think the specified services also includes and expands the scope beyond what you traditionally think. They grabbed. It also includes investing or investment management, providing investment advice, investment management, trading, or dealing in securities, partnership interests, or commodities as well.
Yeah.
So, and we'll see that in the next slide, but it's not the original definition. They've also.
Oh, right. Yeah. We just kind of carved out this reputation or skill here.
Mm-hmm.
But the final regs retain a rule that that limits the meaning of this to certain fact patterns where the business is getting income from endorsements or licensing its appearance or appearance fees. So it's a fairly narrow interpretation. So fairly good for taxpayers. All right, so let's just talk briefly about some of the identified services. Yeah, we're pretty close. We're a little bit over, but we're going to try to wrap it up here shortly.
Well, let's go through it quick. I mean,
yeah.
How do you want? I mean,
yeah, you can go ahead and.
Well, I mean, again, these are the so I mean, health is important. You covered that more than I did, Scott. If you want to touch it, but
yeah, very broad, very broad. Some things are carved out.
I mean, high level, all these topics they're trying. You should assume they're trying to make it difficult if you're practicing these fields to not be included in these fields.
Right.
So there's the disaggregation thing you were going to mention a little bit later, but I mean, like as a general matter, that yes, they mean you. If they're trying to get you probably.
They're exactly.
When in doubt, assume it's going to be.
And there's a lot of, I think, helpful examples in the regs.
Sure.
There's a ton of examples actually, so those are beneficial. But yeah, you're right. They're trying to grab as much as they can in the health-related field. Things such as spas and health clubs and the sale of medical devices are sufficiently tangential to the provision of services to a patient or a recipient that those aren't included. But generally, it's a broad definition.
Yeah, I mean, I think that's right. So they were, in accounting, people ask, well, can't we just use bookkeeping, maybe not preparing tax returns? And the IRS said, no, actually, we're going to include both tax return and bookkeeping services. So that's out. I like, even though it's not listed, performing arts. Screenwriters ask if we don't actually sell our screenplay, can we be out? And they said, again, no, you can't. You're performing arts. And consulting, one of my favorites, they carved out staffing firms. Said that consulting, suggesting that people use staffing firms is not the kind of consulting, it's not the kind of advice they're going to exclude. My favorite comment was a commentator who suggested that the provision of professional advice and counsel to clients to assist the client in achieving goals and solving problems is broad enough to cover any service business that assists clients in achieving goals and solving problems. Which, so it's a little broad. The IRS acknowledged, and the commentator suggested they use the NAICS standard for industry designation. IRS agrees it's broad, says, but facts and circumstances, we're still not going to agree that we're going to limit that. We'll let you know as we decide over time. Mm-hmm. Let's see, financial services. They basically, I mean, the big takeaway between the financial services and the brokerage and whatnot is that they did agree that financial services does not include the actual taking of deposits and making loans. It does include wealth management advice, financial services advice, but generally speaking, and this gets into the brokerage, the financial services, the investing. That if you're an insurance agent and you're basically selling a product for a fee commission and providing some ancillary advice and your management, that's not going to be a business. But the actual brokerage, and that's when they get over to brokerage, they say while taking deposits and making loans isn't considered to be financial brokerage services, it does include it does include arranging lending transactions between a lender and a borrower. But then it carves back out real estate brokers and insurance brokers. Let's see what else we got on that list. Investment management. Again, getting a fee. So it's going to include getting a fee for providing any investment management advice, or including advice on buying and selling investments. The trading and dealing definitions are in line with what you generally expect them to be for other purposes of the code. It's if you are a trader, if you're trading in securities, commodities, and partnership interests, based on all the facts and circumstances, this can be regular, continuous, with a profit motive. Dealing in securities is effectively, not necessarily more activity, but you're doing it with, in the ordinary course of business, arguably, this is my language, for a fee, not for, investment ups and downs. And so you see the definition. And two things, if there's anybody in commodities on here, that they made a special exception to these rules for holding commodities as inventory. Also, there's a concept called qualified active sale, which is saying if you're part of the producing, processing merchant in these commodities, you're not necessarily going to be treated as a dealer or trader. So that's too deep to go into here, but it's something that's always the question: are you a dealer in commodities or are you not? Is it on exchange? So they're still grappling with that, but there are exceptions you should know about. We have to look at it if that's relevant.
Yeah, and this, I would say, this specific language in the final regulations, the preamble, received the most attention. So specified services, I think maybe 25 pages out of the overall preamble was devoted just to this. So very significant amount of attention.
Well, and you and I were talking beforehand. Again, this is for, I'm not assuming the listeners here are, positioned that are interested in the topic with you. But my suspicion is they're worried about certain future suggestions about how to be in these rules would go more to a retail audience.
Yeah.
And so they're trying to go ahead and address that up front and say, look, yeah, we thought of that. It's you're in.
Yeah, right. And that kind of segues into this next language, which is services provided to a specified service business, where, for instance, if you're a law firm and you own the building that you're in, if you want to separate that building from the practice of law, then the regs essentially address that, where you've got common ownership between two businesses, and one of the businesses provides services or property to the other specified service business. Then essentially the regs say, well, the income that you get from that service being provided to that commonly owned business is going to be specified services. It's not QBI. So that's addressed. So if you're trying to disaggregate businesses and carve them up, but you got common ownership, then you really need to be careful.
Well, we're not trying to be wet blankets. We're just saying they were wise to this idea.
Yeah, that was understood. And then just next here, we're closing out here. The 3-year presumption on independent contractors, we mentioned this before, the concern about widespread conversion of employees to independent contractors. Basically, the IRS doesn't want to encourage misclassification, and so the final regs adopt this 3-year look back that says if you were an employee and now you're an independent contractor and you're basically doing the same thing you did before, then you're going to be presumed to be an employee, but it's a rebuttable presumption. And I think there's actually there's an example where basically an employee's activity changed or was materially different, and so you could rebut the presumption. But you've got this 3-year look back, and that's significant.
But probably under changing classification, language is not going to be enough.
No. If you're just changing classification, then you probably need something else. We're going to wrap it up. The last two here, one on implications for M&A transactions. Basically, in an M&A deal where a buyer is acquiring an interest in a pass-through, or an S-corp where maybe the purchase is treated as a sale of assets, the QBI definition excludes the capital gains, but if the acquisition is an asset sale and you're allocating purchase price to ordinary income items, then that income may be eligible to the seller for the deduction under 199 Cap A. And so this is just as a point to note that sellers may be a little more open to allocations to depreciable property or AR if they're on the cash base or whatever, just because they're going to get potentially a deduction. Now, it very well would be subject to potential limitations, but nonetheless, it may be eligible. And that's just kind of a nuance for M&A deals.
Well, and you've also got this, what you're saying, the limitation. People just continue to do what they have always done without realizing this rule exists. And so you may push back.
Right. Exactly. Yeah, and generally there's just reluctance, period, to allocate to those assets anyway. And so
you have to educate your counterparty why they shouldn't care as much.
Right, at least for the next 6 or 7 years. Until this expires.
Or doesn't.
Or maybe it's extended. Lastly, just basis adjustments. Obviously, we didn't really touch on this, but one of the limitations is tied to the unadjusted basis in assets. And so where you have basis adjustments in partnerships, the regulations do address that a 743 adjustment where someone buys a partnership interest may be eligible for a step-up in the unadjusted basis, whereas a separate 734 basis adjustment where you have a distribution is not really an acquisition for purposes of 199 Cap A and would not be eligible for a basis adjustment. The regs note that the Treasury is still looking at this, but just to point out that a 743B basis adjustment may be eligible for a step-up for purposes of 199 Cap A. That brings us to the conclusion. I want to thank everybody for attending. We did get a couple of questions. We will shoot responses to those questions. We appreciate those, and we will definitely get back to everybody. But we appreciate you for joining today, and we will talk to you next week. Thank you.
This concludes today's call. Thank you for your participation. You may now disconnect.